All right, let's get right into it. We're going to tackle a tough truth about investing, a reality that honestly affects almost everyone who tries to make their money grow in the market. This is your blueprint for coming out ahead, for the long haul, no matter what the economy decides to do. So here it is, the number that stops most people dead in their tracks, 97%. According to the data, that's the percentage of traders who actually end up losing money. I mean, think about that. It's an overwhelming majority. So the real question isn't just why they lose. It's something way more important. And that is exactly what we're here to do. We're going to break down the most common mistakes that put people in that 97% camp, and then we're going to lay out the exact blueprint for how you can join that elite 3%. And believe it or not, it all starts with the battle inside your own head. Yeah, before we even talk about stocks or strategy or anything like that, we have to talk about mindset. The biggest hurdles you're going to face are almost always psychological. Winning the investing game really starts with winning the mental game. And the first trap? Well, it's overconfidence. This slide really says it all, doesn't it? When the market's hot and everything's going up, it is so easy to feel like a genius. The 97%, they fall right into this trap. They think they can't lose, and they start completely overlooking the risks. But the 3%? They practice what we'll call cautious optimism. They know they don't have all the answers, and, this is crucial, they always expect the unexpected. And if you need proof, check this out. This isn't a joke, it's a real thing that happened. When a portfolio picked at random by a monkey can go up this much, it proves that a rising tide really does lift all boats. It's just a powerful, kind of funny reminder to stay humble. Which leads us right into the next trap. Right after overconfidence, you've got its close cousin, impatience. You see it all the time. An investor buys a great company, but when it doesn't double in a month, they get bored, they sell, and they go chasing the next shiny object. And that constant chasing means they often sell right before their original investment finally pays off. So what's the antidote to this? Well, it's a mindset shift we can call 10-year increment thinking. You have to plan, you have to invest, and you have to think in decades, not days. The moment you do that, you stop being so reactive. You let time do the heavy lifting for you, instead of letting your emotions work against you. And of course, that brings us to the ultimate emotional mistake. Panic selling. Look, seeing your portfolio drop is terrifying. I get it. But instead of reacting with pure fear, the 3% react with logic. This checklist right here, this is your defense. It's your emotional circuit breaker. Before you hit that sell button, you ask yourself these 4 questions. If the answer to most of them is no, then the absolute best thing to do is, often, nothing at all. Okay, so once you get your psychology sorted, you've got to avoid the common tactical blunders. These are the big strategic mistakes that can wipe you out, even if you are the most level-headed investor in the world. The source material for this uses a fantastic analogy here. Borrowed money, leverage, it's like fire. Used carefully and responsibly, it is an absolutely incredible tool that can warm your home and accelerate your wealth. But if you get reckless, if you borrow way too much for some short-term gamble, it will burn your entire financial house down to the ground. The danger isn't the fire, it's how you use it. Let me ask you something. Seriously, would you give a total stranger on the internet your bank account password? Of course you wouldn't. I mean, it sounds completely absurd, right? But that's pretty much what a lot of people are doing when they make this next mistake. When you blindly follow a stock tip from some random person on social media without doing your own homework, you are trusting them with your money, and they have zero skin in the game if they're wrong. We saw this play out with certain stocks where people piled in at the absolute peak of the hype, only to sell at a huge loss when everyone got bored and moved on. So listen, learn, but never ever invest blindly. The classic way to protect yourself from any single catastrophic mistake is diversification. It's the golden rule that everybody's heard of, but so few people actually do it right. And it doesn't just mean owning different stocks. It means owning different types of assets. Spreading your money across US and international funds, some real estate, and maybe even a little bit in alternatives, that gives you protection. Now, you might not get that one crazy home run, but you also won't suffer a catastrophic loss either. All right, now for our last section. And this one's a little counterintuitive. After all this talk about risk, you might be thinking the safest thing to do is just hold on to your cash and wait. But that, in and of itself, is one of the biggest mistakes you can possibly make. Here's the hard truth. Sitting on a big pile of cash is a guaranteed way to lose money over time. And it happens in 2 ways. First, you've got inflation, which is like a slow leak, just eating away at your buying power year after year. But the second one, opportunity cost, That's the silent killer. It's all the potential growth you missed out on because your money was just sitting on the sidelines. And this chart makes that danger crystal clear. People often lose far more money waiting on the sidelines for a crash that might not even happen than the people who just stay invested and ride out a temporary downturn. Trying to perfectly time the market, it's a fool's errand. You are almost guaranteed to miss out on way more gains than you'll save from losses.
So we've walked through the psychological traps, the strategic blunders, and even the risk of playing it too safe. Let's put this all together now into a simple, actionable blueprint for how you can be a part of that successful 3%.
Here it is. This is your guide. It all boils down to a pretty simple set of principles, right? Practice that cautious optimism and think in decades, not days. Use debt as a tool, not a casino chip. And for goodness sake, do your own research. From there, you protect yourself with diversification, you invest consistently, and you make a promise to yourself to never, ever let fear make your decisions for you. At the end of the day, investing really doesn't have to be this super complicated thing. By just avoiding these common pitfalls, you put the odds squarely in your favor for long-term success. So the final question I want to leave you with is this. Take a hard look at your own habits. Your portfolio is a reflection of your decisions. Are you building a winning one?